But the first rates on your screens this morning, and quite a bit of relief actually. We made it to that 21,600 mark. HDFC Bank, of course, has covered ground 1.25% higher as we speak right now for HDFC Bank. IndusInd Bank is going to be the other earnings reaction. It's made it back to 1,500 on HDFC Bank. IndusInd Bank, though, absolutely flat as we speak, although it was a stable show when it came to the NIMs, and the operational profit as well has grown now for a 12th straight quarter, but you're not seeing any meaningful move come by on IndusInd Bank. That's at best just marginally higher as we speak right now. Bajaj Finance, the board is going to be meeting on January 29 to consider a fundraising via debt. That stock holds up nearly about 1%. Poonawalla Fincorp, like I said, decent set of numbers. The AUMs have seen an uptick of over 57%, gap up 4% higher for Poonawalla Fin. There's also Finilex Industries. The numbers are decent. EBITDA jump up of 31%. Margins have expanded 360 basis points. That stock marginally higher. We're going to be chatting with the management as well in the due course of the show. And then Shalby, which is looking to acquire that 87% stake in PK Healthcare for 102 crore rupees, 2.5% of an uptick coming in for Shalby this morning. What is Metro Brands up to, and then what is Polycab up to? Metro Brands, of course, has been the big disappointment. That stock has tanked 5.6% right now and drifts even further lower. Polycab, though, it's a little bit nimble, 0.5% of an uptick. But remember, the stock is also in an F&O ban today, so you're not really going to see too much of a wild reaction come by. But it's stable, I would say, at 44.50, even though the numbers did fall short of market expectations. But for the Nifty, it's not a bad start, Kunal. Some relief coming in. We've made it back to 21,600.
Well, yeah, I think that first, sign of confidence is quite good for the indices. The Nifty and the Bank Nifty both are moving in sync with respect to the percentage gains. And the premiums, even though it's going to be an expiry week next week, are still on a slight healthy note than the discount which the indices have gotten to a couple of days back. In terms of opening trade, I would look at BHEL as a stock which has hit a fresh 52-week high yesterday as opening trade. I think the stock is looking quite strong enough, and closer to 210 could be a good buying range.
All right, Naresh, let's get in your take then as to what you're making of the start to the market this morning, and what is it that you're punching in as your first trade, given the fact that we've clearly taken cues from the global screen.
So good start across the board, across mid caps, small caps, large caps. So looks positive. The trade would be Petronet LNG, which has been showing a lot of relative strength over the last few days, could continue towards the 260 mark.
Not bad. I've been for a day of stability rather than a lot of up and down here. Anish Walke joins us, Deputy CIO Equity with ICICI Prudential AMC. Anish, good morning. Thank you for joining us. What would you make of the current construct of the market based on valuations, behavior and liquidity? How would you map that for us?
So I'd focus firstly on valuations and more importantly on earnings growth outlook. So valuations, at least in the large cap, are broadly in the reasonable zone. One could argue they are slightly expensive, but broadly they're in the reasonable zone. And therefore, from here, what matters is earnings growth. And earnings growth obviously then depends on the economic outlook. And our view is that, at least for the next two to 3 years, right, we look like cyclically we are well positioned. And the domestic cyclical sectors should do well. Frankly, flows are always unpredictable, and one can spend a lot of time discussing them. But my focus is more on valuations and earnings.
Valuations are above historical averages. And when valuations are above historical averages, future returns are compromised. Is that a very simple way of looking at markets?
So it depends on how much above averages, right? If they're our equity valuation indices, right, we have this coding of green, red, and neutral, which is yellow. Obviously, if they're far above historical levels, right, then you don't make returns, even if the economy does well. But we're not that far above historical averages, right? So our view is that if earnings growth comes through, which, as I said, depends on the economic picture, then valuations, even if valuations moderate a bit, right, your returns should be reasonably healthy.
HDFC Bank numbers, not to discuss a stock, but to discuss A, macro indicator. It is India's biggest bank, fourth largest in the world. They are suffering because liabilities are not getting created. As a result, they will have to slow down. So if HDFC Bank, which is the best brand, is struggling to get deposits and they have to slow down growth, others will have to do so. If that is the situation and banks don't lend, don't you think a slowdown is inevitable?
No. I wouldn't look at it that way at all. See, there are three, basically, if you look at the overall economy, right, there are three sources of financial intermediation. There is capital markets, which is, I'm saying, asset managers like us. There are insurance companies and there are banks, right? And ultimately, it's the household sector which chooses which intermediary they want to. Now, if it so happens that the household sector is choosing to park its funds in insurance through insurance products or through asset managers, you can have a healthy economic outlook because financial intermediation is still happening. Savings are still being given to investors, while bank deposit growth remains moderate. So one should not assume that bank deposit growth is essential or very robust bank deposit growth is essential for economic growth. If intermediation is happening through other channels, that is still pretty good. And that's what we are seeing, right? Where we are seeing that people are allocating more money to asset managers and insurance flows are also reasonably high. So one should not draw that conclusion. Secondly, of course, I don't want to comment on single banks, but we should evaluate whether the banks' numbers were not healthy or whether expectations were unreasonably high. So let's wait for other deposit growth. Overall in the system looks reasonably, I mean, it's slightly on the lower side, but it's certainly not at worryingly low levels.
So, Anish, you were talking about that domestic cyclicals is, of course, one pocket where you do find comfort right now. Where else do you find valuation comfort in the market? And I want to just, point a direction to the most popular trade of last year, that's PSUs. Again, it's a very large umbrella there, but the most popular ones were your defense, railway, power financiers. Do you think one's got to be a little cautious here? Or do you still think there is both growth as well as value on the table?
No, I think the easy money in the PSU space has been made. From here, one has to be more discerning. It's not that straightforward that one can keep parking money in that space and getting rich. But in terms of so domestic cyclicals is our preferred area, as I mentioned, right? So that includes automobiles, cement, capital goods and industrial goods, and also non-bank financial intermediate like insurance companies and asset managers.
But where within autos, again, is your bias towards? Because what we're seeing is a sudden re-emergence of two-wheelers. The passenger vehicles, of course, had their time in the sun all through last year. But the slowdown is quite evident in the tractor numbers. And again, there's a different sect with CVs. Is it a blanket buy call when it comes to autos?
Also, tractors is cyclical, and that cycle doesn't necessarily follow the economic cycle. It's not necessarily consistent because it's not linked to industrial output. And tractors have been healthy for the last few years, so it's not surprising that tractors can slow down while the rest of the economy is still doing well. So I wouldn't say tractors, but yes, I think passenger vehicles should recover. I don't think we will have a strong economy and weak passenger vehicle sales for a very long time because passenger vehicles is linked to the economy, and I do think two-wheelers should continue to do.
Morning, Anish. We have to a certain extent seen these very exaggerated reactions coming in on individual stocks, be it the likes of an HDFC Bank or Polycab, just purely for example purpose. I just want to understand, do you think that these sort of reactions have been merited, that the stocks have been meted out with by the markets, given that we did not see this sort of a move, say, in the last couple of months for the market?
See, some of these reactions are driven, one by expectations and second by ownership. If stocks are very, very well owned broadly by a lot of people, then the reaction tends to be exaggerated. So one shouldn't read too much into individual stock reactions on this.
I'd like to draw your attention to the fallout of IT. Job hiring is slowing down. Impact on fresh campus recruits is also slowing down. AI will ensure that less job creation happens. What kind of impact this slowdown in IT hiring could have on this entire so-called IT ecosystem? Property prices in Bangalore, property prices in Chennai, luxury cars. What happens because of this?
So look, over the longer term, IT will have an impact. But the near term, right, I think what we are seeing is not necessarily the impact of IT, but two other things. One was that the expectations had gone up too high because even amongst industry participants, right? Because during COVID, we had very strong growth. And to some extent, people had overhired. And we are just seeing a normalization from those overheated expectations. The second is that if we look at the economic impact, right, broader economic impact, we have to look not just at the Indian listed vendors, but also at the GCC space, right, the captives that all the overseas businesses now run in India. And actually, there has been some migration in activity from Indian vendors to captives, right? I was looking at some of the numbers. There are now apparently 1,600 captives in India, and the total workforce there is about 1.5 million. So, from an overall economic perspective, we might not be seeing as the softness that we see in the Indian vendor space is not necessarily true of the overall space. So I wouldn't read that into negative economic impact for the rest of the sectors, right? The Indian vendors have to contend with the challenge of captives taking share and demand moderating to more reasonable levels from the froth and overheating that we had seen during COVID.
So, Anish, what are your bullish calls right now in the market? Because just about everyone is tilted towards A, of course, financials, banks mainly within that, and B, the emergence of EMS, renewables, the new energy sector, if I can call it that, is being looked at as the next breakthrough.
So our portfolios are public, and you'll see we were one of the most underweight portfolios on domestic banks. We have a bigger skew in financials towards asset managers and insurance companies, but we were significantly underweight banks. Second, other than that, we are, at least my portfolios are skewed towards automobiles, industrial and capital goods, and cement, because I do think the domestic recovery is looking good, and that outlook hasn't changed.
What is the right way of looking at industrials? I mean, I understand that there is a multi-year cycle, but if I look at some of the real good niche industrials, Thermax, Siemens, ABB, the valuations are pretty much trading at consumer companies now. So they are commanding ratios which essentially consumer companies have commanded in the past.
See, the fact is consumer companies are staples, so they remain steady, irrespective of where the economic cycle is. But here you see a stronger cyclical uptick in earnings, right? So when your economic outlook, at least for a 2-year or a 3-year period, is strong, it's reasonable to assume that their valuations will be elevated. Second, I think we over focus on price to earnings ratios. We also have to look at the profitability and consequently the dividend yield that you get. Right? So some of these companies, while the PE ratio looks high, the ROEs are so strong that they pay very healthy dividends. And if you compare the dividend yields with the rest of the market, the gap is, I'm not saying they're cheap, but the gap is less outrageous.
Wanted to also just understand your outlook then in specific to what you're witnessing within the entire mid and the small cap space, given the kind of momentum that we witnessed last year, the kind of euphoria as well that we've seen. Do you think that maybe there's a chance that the sector got overvalued, and what's the play out for the rest of this year?
So mid and small caps, we are clearly cautious and we are concerned about valuations. So valuations in large caps are reasonable, provided earnings growth comes through, but mid and small cap is very, very, very niche.
Okay, very cautious there. Good to have you on board. Thank you so much for giving us your take as to how you're navigating the markets as well as your forward-looking statements. That's the view coming in. Domestic cyclical sectors could do well for the next 2 to 3 years, and a little bit cautious on PSUs as well as broader markets. Scaling up and as things stand, holding out at the 21,658 mark. But speaking of market momentum, let's hear it out from Quant Mutual Fund Sandeep Tandon. He talks about the markets, stocks, and some of the top themes as well that he believes one should steer clear from, as well as top themes for the year ahead. Will it be the year of PSUs, energy, or pharma? Let's hear him out.
Next 30 years, the relevance of leverage economy as a concept will decline. The concept of a real economy will come back. So banks are the biggest beneficiary of this thesis of leverage economy, okay? And US, why we are so bearish on US in long term, is this thesis, okay? A lot of data points are changing. The concept itself is changing, okay? And then you look at some of more data points we look at, like in 2023, I talked about this year belongs to the most neglected zone, okay, most hated zone category. The admire category stock will not perform. So as a thesis, we spotted that opportunity. That's the reason all public sector banks have done very well as compared to private sector bank. PSU in general has done very well. Metals, nobody used to want to talk about metals, have done well. Okay, media has done well. Mining has done very well. Okay, we were very early in spotting in the beginning of the year in 2023 about pharma. They were in neglected phase. So when any sector or stocks are from a behavior analysis perspective are in trading in the most admired territory, and banks were in admired territory. If you really look at the banking cycle, it peaked out in January 2008. They were all in admired territory. They corrected sharply. But from September 2021, they started coming back from neglected zone. They again reach the most admired territory. Okay, and one of the reason we thought, okay, this is a data point. At least it was very difficult to make money. And one of the reason, if you look at ICICI Bank, we exited our core position maybe 1.5 years back. I think August 2022 we sold.
You sold HDFC Bank also completely.
Yeah, we sold HDFC Bank in September.
You only own RBL now.
So we have a thesis for smaller banks or close to book value will do very well. So RBL Bank or Karnataka Bank, JNK Bank. This is a disclosure is there in our portfolio, so I can talk about it. It's already disclosed. Okay. So we have some of these names.
You like smaller banks which are trading in and around the book value.
Yeah, or below book value. When we bought, they were all below book.
So let's split the market the way you look at it, the admired category and the so-called neglected category.
Yeah.
What is in the admired category right now according to you, apart from financials?
So I think I will not get into any specific sector. Is not looking like, obviously bank was one of the private sector bank, let's put me. Private sector bank, private sector NBFCs are still in the most admired territory. Some of the consumption names are still in admired territory, not all. Okay, though we are very turning constructive on the consumption as a cycle, they are still in admired territory. Anything which is in admired territory are also by default are also over-owned stocks. Okay, so over-ownership is also their byproduct. Okay, over-ownership is a byproduct of admired territory. So if you look at where is the fresh inflow will come from, okay, people already like look at banking sector. Most of the fund have 35 to 40% exposure in banking.
What is in this so-called neglected category which you think you would like to go overweight on and you've been increasing your exposure?
So I think if I have to look at the bigger sectors, I think pharma is still in the neglected. Okay, it was in the most hated zone in February, March of 2023. They have improved a lot, but still neglected. So I think pharma has a sector. If I look at for next 5 years, let's say minimum 3 years, I think that's the one cycle which is in our favor, which is very meaningful sector for the market and the index itself. So that's the one sector I'm very constructive. Metal also has a very sizable bets, metal and mining both. Okay, that's another area, irrespective of China, irrespective of dollar. I think India consumption is going very well. So that's another area which we like. So we are, if you look at as a fund house, we are grossly overweight. I'm using the word grossly overweight on metals and mining. I think mining will be a surprise element. We have seen a small trailer of 2023 about minings. I think globally, we believe mining should do very well. Okay, that's the reason, particularly lithium related stuff. Okay, that's the reason we are equally positive on the Australian market also. Semiconductor in a big way. I think these are the theses will come back. So mining, metals mining. I still like media as a thesis, okay? But media sector is very small, okay? So you can't have very sizable bet. We do own some like 2-3% of the portfolio is also in the media space. PSU is another theme which I think has more legs.
More legs?
Yes,
isn't
still
PSU
has.
like the most...
Yeah, it has moved up. So like if I look at from 2021 onwards, they were in neglected zone, hated zone. Now they have yet to reach the admired territory. Okay, so it has potential.
Even after the recent run-up in defense and railways.
Yes, they have not reached those euphoric
Your
phases.
top 4 holdings actually are apart from Reliance, you have SAIL, you have Hutco, you have Nalco, you have GAIL. You are buying PSUs.
Yeah, we have been. It's not now. We have been very bullish for last 3 years on PSU. Okay, even January 2023. If you recollect, a lot of people remember that we have exposure in Adani groups. Okay, Adani group exposure was 6%. But what hurt us in that period? The casualty happened in the PSU. We were 25 to 28% exposure in PSU. But if somebody do a postmortem analysis now, we were ahead of the curve. So we have very large exposure for quite well.
You've sold your Adani exposure completely.
No, we still have. We sold. See, we manage money very dynamically. When it is all about taking a call when unknown risk also. So you have to manage a known and unknown risk both well. So if any unknown risk hit, we do take conscious call. But we do have some exposure, like if you look at our portfolio, we have very large exposure on Adani Power. That's the one stock we have very large exposure.
Why do you like power?
So power is a larger thesis. I think every fundamental analyst has given in a thesis. We like energy as a thesis, okay? If you really look at our portfolio, the biggest overweight is energy, which include power also, which include OMC companies also, which include oil and gas companies, okay, even the crude companies. So whether you talk about these names, could be the very size, it could be what, 20-30% exposure will be there. If you look at the collective power and energy put together, that's a large exposure. We think this was a sector which was also in a beaten down territory, neglected zone, and obviously we all know what sort of gaps are there in terms of power needs are there, which is well understood. This is area. Look at the NTPCs of the world. I'm just giving you, generally we don't talk about names. An example, nobody wants to willing to touch government company, okay, biggest contributor in this industry. Nobody will talk about, and then you look at how Power Grid, NTPC and all power companies has actually rallied significantly. We think they have still not peaked out. Yes, easy phase is over there also. If you expect that easy phase is there, they can double or triple even from the current level, then answer is no. But can they outperform the market? Answer is yes.
What can double from the current level?
I think individual names in pharmaceutical sectors, some of the banks, PSU banks still have more potential. Smaller PSU banks, okay, where numbers are still changing, okay, all this NPA related things, which were those were this everything. In fact, write backs will come in a big way, and they are still under-owned. People don't look at the mindset. Okay, I deal with in my previous avatar as a banker and broker, we have dealt. A lot of people have mindset not to touch PSUs. Today, people are forced to participate. Okay, it's not like with their interest they are buying, because of price movement is so furious and you have a pressure of underperformance, so you are forcefully buying, you are not liking it. Okay, there will be, I think that phase is yet to come where people will be sucked in this space. Okay,
we are not there yet.
No, we are
you
not
will
there.
not look at selling your you will not look at booking your profits in PSUs then.
See, on a rotation basis we do stock specific thing, but as a larger thesis I think PSU has more legs.
How do you see 2024 being different from 2023?
Okay, so this is an important question. It is going to be very different. Say, I have been talking about a volatility expansion phase. We always talk about what type of market. So 2018 till 2023, I said global employed volumes of asset class will remain elevated, which means volatility will be very high, and hence people will not able to participate or monetize the entire single cycle, and which happened. Now that cycle has peaked out. Okay, if you ask me next 3-4 years globally, okay, the volatility will come down and people will see more stability coming back. The more stability means the conviction comes back, even lazy capital also comes back to the market, which is people who are very conservative. That's the reason I said 2024 will be far better than what we have seen in last 4 years, okay, both from FDI, FPI as well as domestic flow perspective, because you get money from conservative player only when you have stability in the market or less volatility. So the most important aspect will be less volatile, even from a geopolitical perspective. I think we are just working on the yearly data, so we are trying to gauge, that even let's say crude will be very low. The volatility on the crude will low, right? The currency walls will be low in 2024.
But given that there are 40 elections this year, you still think volatility will be less?
So this is one point in one of the channels I highlighted, if 40 countries, more than 40 countries are going to go for this thing. Typically, government who don't want to disturb the mood. Okay, it's a mindset, people wants to have a cozy environment, happy environment. And that's the reason even none of the government will going to tinker any on the taxation related things. That's the reason we expect something similar in India, that before nothing will happen in this budget also. Okay,
but so there's another budget which could happen in July or August.
Possible. So, but if I have to look at, I'm not looking just India, but when I'm talking about 40 countries, okay, and they all will happen different point of time in this year. So I think generally the mindset will be more constructive, more positive. So I expect less, and then I'm linking with my volatility cycles also. If I look at combination, I think the volatility will be far lower.
Okay, that's the words of wisdom coming in from Sandeep Tandon, and quite the contra call he has had, right? Nikunj, no banks in his portfolio, reliance in abundance. What he's now betting on is smaller PSU banks. And those are the themes he's working with.
It's admirable to say that, look, I'm going to be zero when the weightage of financials is 35%. Most of the fund managers have a weightage which is higher than benchmark, largely because of the construct of where it is. He's got a very unique strategy which is called dynamic management, that you cannot just buy stock based on valuations. You have to look at behavior, construct, valuations, momentum. So that's a very unique strategy he brings on. I mean, good luck to him. I mean, look at the franchise, what he's created. Was not the first mover. He just started like 3-4 years ago, in and around COVID, and the equity sides under management is 50,000 crore. That's like enviable for any fund house right now. And you know, a lot of these new outfits are now challenging. Sameer's got a unit. Kenneth and Rade is coming up with a mutual fund scheme. You got Rajiv from Parag Parik of PPFS. Suddenly the size under management is 50,000 crore. So while we may look back and say, okay, the dominant player is still SBI, HDFC and ICICI Bank, but the smaller outfits are getting lion's share of inflows, and which is what is now becoming a disruptive market threat for at least the PMS guys. PMS schemes are now 20 to 25,000 crore. Look at what some of the schemes, large ones are like Sunil and Saurabh. So there's money coming everywhere. If you have a differentiated product option, I think you really have
an edge.
There.
Yeah, absolutely. Okay, just looking at the texture right now, we've made it a good 135 points actually up in the green is where we're currently at. So we're comfortably above the 21,650 mark. Not bad at all really for the index. A good 183 points in the cash, in the spot Nifty. TCS, HCL Technologies, TechM, Eicher Motors. These are your top 4 movers within the index right now. IndusInd Bank is actually a drag now, by the way. 1.25% lower is where that stock is. So it started off okay, but from there, it's slowly been sliding down, although the numbers were in line with what the street was anticipating. Look at Reliance Industries. Ahead of its numbers later this evening, post-market hours, the stock is absolutely flat. In fact, mildly soft right now in the cash markets. There's also Unilever ahead of its numbers. Mildly in the red right now. SBI, L&T, HDFC Bank, not doing a whole lot, but yes, HDFC Bank has managed to climb up in the green. It's holding up 0.5% as we speak. But here's the exclusive interaction as promised, and a very rare voice from the startup ecosystem. FarmEasy's co-founder, that's CEO Siddharth Shah, talks about their valuations, listing plans, and of course the thyroid care bet in an exclusive chat with Avan.
The valuation at which we raised our pre-IPO round was closer to $5 billion. The rights issue that we did was closer to $500 million. But having said that, I just want to point out that the rights issue was done only for the benefit of our existing shareholders. And the idea was that there were shareholders who had invested in the company at, let's say, $1 billion, $2 billion, $3 billion, $5 billion. When we did a rights issue, we wanted to do a deep discount rights issue, which means that all shareholders get a chance to participate at a value which we thought was exceptionally low, and thereby for those who came in at a higher price could average their price such that when the company does well and bounces back, they're all back in the money. And I think that's evident from the kind of support that we've received from all our shareholders. Almost all of our large shareholders have participated as part of the rights issue. In fact, before the rights issue, we had about 20,000 odd retail shareholders, right? Those have also participated in the rights issue. And the biggest testament is the fact that our employees have invested 132 crores in the rights issue, right? So while we wanted to raise about 3,500 crores, the demand that came in was 3,950 crores. So I think it's a big testament to where we are. And I do believe that the company is doing exceptionally well, and we will all come back, and at the end of the day, all our shareholders will be rewarded for their trust and faith, and the team will work really hard to ensure that they make money.
No, I definitely want to talk a lot more about the rights issue and the debt component, etc. But let's go back to when you bought that stake in Thyrocare. That was about 4,500 odd crore rupees. What was the the sensing behind the deal? Was it largely from moving from low margin drugs to high margin testing services? Was that the thinking behind it?
The thinking behind it was that we still believe that there is a phenomenal potential to create a digital platform on top of the physical infrastructure that exists today in the country and provide access to affordable outpatient healthcare across the length and breadth of India. Now, through our platforms like Retail.io, Acnamed and FarmEasy, we were ensuring that retailers, customers, hospitals get access to high quality, low cost, affordable healthcare products. But to complete the loop of outpatient healthcare, we thought that we need to ensure that people get not only medicines but also services. That is diagnostics, people get access to information. And we thought the best way for us to scale that would be to have a partner like Thyrocare within our ecosystem. And I'm glad to say that Thyrocare today is the largest lab in India in terms of number of tests being conducted, has presence across 280 districts through 4,000 plus partners. And we are now able to go out to all the consumers, for example, of FarmEasy and offer them affordable diagnostic testing at home through a network that has the highest percentage of NABL accredited labs and a promise guarantee where we run something called as on time or free promise, which means that if your tests don't get done on time, your phlebotomist doesn't show up at your doorstep on time, your testing is free. And I think this guarantee of on time or free on top of phenomenally reliable network is something which is a testament to what has worked well for us after having bought out the majority stake in Thyrocare.
Okay. And for the overall buyouts that the company has done, including that of Thyrocare, how has that panned out? How much of the profits come from Thyrocare?
So today, I would say that the way we look at the companies, we look at it into two parts, right? There is products and services. And the people that we provide these products and services to, like I said, are patients, retailers, hospitals and doctors, right? And within this, we now look at, the way to think about it is the entire acquisition cost for consumers, maybe retailers or hospitals, is now spread across this entire base or plethora of products and services that we can provide, right? And the way we think about it is that the entire team at the HO, their cost is again spread across this, right? So it is, I can actually tell you what kind of gross profits that we make, but it'll be but it'll be unfair to say that okay, it's part A which is giving the overall profit, or part B, because then it's a question of allocation, right? Whether I allocate my time to diagnostics, you'll feel, hey, these guys are making a ton of money on medicines, or if I allocate my cost to, or the HO cost to medicines, and you'll feel, okay, these guys are making a ton of money on diagnostics. The point is, to look at the platform as a whole, and I think as a whole, I can tell you that at least on an operational cash flow basis, right, or the operational profit for the first 6 months was at an EBITDA level north of 60 crores, right? So I think the platform has turned operationally profitable on a day-to-day basis, and that is something that we are exceptionally proud of in terms of what our team's been able to achieve.
Okay, and there was something interesting that you brought up earlier that maybe I want to touch upon, because yes, there are rivals within this space, be it 1MG owned by the Tata Group, there's of course Reliance owned NetMeds, Flipkart Health Plus, and of course a number of other names. Tell us about how your market share has been affected or impacted on the back of this, and how really indirectly a lot of your competition as well feeds into Thyrocare that you were discussing.
So look, the way we think about it is, first of all, the market is phenomenally large, right? I think there is two ways that you can look at the market. You look at, hey, all these digital players or new age players who are promoting digital, accessible, affordable healthcare. What does your market share inter say? Or what is this group per se as part of the overall outpatient healthcare ecosystem, right? I think all of us put together are barely scraping the surface. We are all below 10%, right? And sometimes we go ahead, sometimes they go ahead. I think the way we think of ourselves is a combined platform, right? And I think we've just come out with our FY23 numbers. We are well north of 6,000 crores in terms of net revenue, right? And I think that clearly puts us in a phenomenally large position to be able to leverage our network and do the best across all of these segments. And I think you're right. We don't think of any of these people purely as rivals or competition, right? I think there's a lot that all of us are doing together to promote digital healthcare. But as an example, right, there are areas where all of these players are taking a similar approach like us, which is to provide 360-degree outpatient healthcare. And now there are certain areas where, like I said, Thyrocare has a presence, but these people do not. And they're very happy to work with Thyrocare as their preferred testing partner, right? And I think without going into much details, almost 20% of Thyrocare's revenue comes from these partners, right? And I don't want to take any specific names, but a large part of Thyrocare's business, as we all know, is B2B, right? So Thyrocare has 4,000 plus partners to whom it provides diagnostic services. These partners in turn have their own consumers, right? So it's a B2B platform, Thyrocare, and a large part of Thyrocare's B2B revenue comes from working with these new age partners also and collaborating with them, right? So we believe that it's a very collaborative approach that we have, and that will ultimately fuel our growth as well.
And given that the focus really has been on maximizing revenue and overall profits as well, you were talking about 6,000 crore plus. What about the average order size? Has that really gone up as you're looking at, providing integrated products, cross-selling, all of that?
Certainly. So our focus is that for the consumers that we have, right? And I'll give you a couple of measures, and I spoke about this at our AGM some time back. Today, more than 77% of revenue on FarmEasy comes from repeat users. So a large part of focus has been that we work with consumers or retailers or hospitals and see what best we can do to take care of their entire need, right? Because there's just such a phenomenal number of retailers, let's say 100,000 retailers, or couple of thousand of hospitals, couple of thousand doctors, and I think we have 39 million plus registered users on FarmEasy. The idea is that even if we were to get, let's say, a 40-50% wallet share out of these, I think we'd be at a phenomenal scale, right? So today, for example, in Mumbai, of the total value of products sold in the city, our platform accounts for about 10%. Now, 10%, is it a large number? It's a large number. But if I look at the example of Gurgaon, we are 40% of that market, right? So, I'm just saying the potential to just grow in terms of where you are is just so phenomenal, right? And that is what our focus has been in terms of getting more per user and giving them all of that, or more per retailer, more per hospital, and so on and so forth.
Now, let's also talk about the overall EBITDA. You did touch upon that, about 60 crores. Do you think that this trend is only going to sustain down the line, and how so?
We believe that it should get better, right? Now I don't want to make any forward-looking numbers and statements, but I can tell you that for the first 6 months we were at close to 60 crores of operating EBITDA, right? Obviously this is not accounting for any restructuring cost or finance costs which are related to our Goldman debt or the process of rights issue. But I'm saying at an operating level we believe that the model works today, right? And we believe that with improved scale, the focus of providing 360-degree combination of products and services, they should only yield better results in terms of operating leverage and better return in terms of all our investments that we made so far.
Let's talk about the 3,500 crore fundraise. The fact that Ranjan Pai as well of Manipal, he pledged an investment of 1,300 crore rupees. Tell us a little bit more about this rights issue. Is he going to be joining the board of API Holdings?
So, the investment of Dr. Pai is obviously subject to CCI approval. We are hopeful that it will come, pretty soon. But yes, assuming that the CCI approval does come in, we do expect that Dr. Pai's family office, along with his affiliates, will be investing at least north of 1,000 crores. I'm not sure if we will get a chance to have the entire 1,300 crores because, like I said, the rights issue has been oversubscribed, yes. And by the waterfall mechanism that we had put in, unfortunately, we may not be able to provide Dr. Pai the entire, quantum that, he would have wanted to invest. But yes, subject to CCI approval and closure, Dr. Pai will be joining the board of API. He will be a non-executive director. This investment is coming from his family office. It's not coming through Manipal Hospital. So he does not intend to take an operating role, but we do expect that Dr. Pai will join the board of the company.
And overall public listing, IPO plans, anything?
Hopefully soon. I think there will be the right time to do that.
Give us a sort of a timeline. Is it years ahead? Is it a few months?
I don't have a timeline right now. I think the first focus right now is to get the first regulatory approval, which is from CCI, and get these investors on board. But I must admit, we have over 20,000 shareholders today, right? Our corporate governance is like that of a public company, right? Even today, more than 1/3 of our directors, as required by law, are independent directors. The head of our audit committee, Subbu Subramaniam, who used to be the CFO of Titan, is an independent director. Our chairman today is Mr. Aditya Puri, right? So in terms of corporate governance, we behave and we work as if we are listed. I know it's our obligation as management to get a listing done so that our shareholders also get a shareholding in a listed company. We know that that's an obligation on us, but we also want to come now to the market where we've proven our performance, right? The last time in 2021, 22, when we wanted to go public, we were asking people to bet on our potential. I think the Indian markets have told very clearly to all the companies that come to us with performance, we will reward you. Come to us with potential, we want to see your track record, right? So I think it's important that we go. We're on our way there, right? So which is why I said hopefully soon. And we go to people saying that, look guys, we've proven what we at least wanted to, and I think that should be a good time for us to go public.
Right. Okay, that's the take coming in from FarmEasy. Quite an interesting management over there. Let's just revisit where the market is settling in at. About a 0.6% move is what you're seeing right now. 21,650 is where we're currently at. Guess what's actually topped on the Nifty right now? It's actually tightened. So, just a short while back, it was TechM, etc., and along with TCS, which were actually holding up, but it's now tightened, which has scaled up a good 3% in trade. There's ONGC, there's NTPC, and then there is Axis Bank, which are all the ones which are forming the top contenders on the Nifty. Reliance is now down 0.5% ahead of its numbers, and Nikunj, IndusInd Bank has fallen 2% now.
So actually, look, the stock's seen a 36-37% run up. I think I was looking at data in the morning. So correction, numbers are not that great, they'll warrant an upside. But numbers, despite the fact that asset quality has gone down and there is a drip, numbers are not really that scary that it will warrant a sell-off like HDFC Bank. For me, I thought that HDFC Bank numbers are a macro event. That okay, if the best bank, India's biggest bank, the most well-known brand, if they are having a problem in terms of getting CASA, which is low-cost deposit, which is liability, the fixed deposit which you do. I'm breaking it for our viewers. That means that other banks will also suffer, but that is not the story. IndusInd Bank CASA is decent. Federal Bank CASA was decent. So I think now more and more focus would be on, is it a HDFC specific problem or is it an industry specific problem? It's an HDFC specific problem because you need, say at that size, you need a lot of low-cost deposit to grow. And why would anybody go to fixed deposits right now when mutual funds sahi hai, campaign is also on, right? When fixed deposits are giving you 6-7% return, mutual funds are giving you better returns. When you have a RM which says open a fixed deposit, but please also buy mutual funds. So just think about it, right? I mean, there's limited money which gets generated into saving, and as it is, the saving rates are coming down. So for that engine to hum, you don't need like a push. Now you need a serious horsepower push, and that is what is happening in HDFC Bank. I mean, it's just size. The size itself sometimes becomes your enemy, and that is what HDFC Bank is for you.
Okay, fair enough. HDFC Bank aside, which has been the key talking point this week, the other one has also been Ayodhya, the biggest event of the year, the inauguration of the Ram Mandir. In fact, it is clearly a major powerhouse, economic powerhouse in the making, as the economy will get a massive facelift. In fact, you've got the top internet searches as well, with Ayodhya being among right up there. Religious tourism as well has been seeing a massive growth push. So all you should know about Ayodhya 2.0, we get you that coverage only on ET Now.
Okay, just looking at the market texture, while of course it's Reliance and IndusInd Bank which are the drags right now, the rest of the index is actually holding out. Look at HDFC Bank, because that, while it started off with that 1.5% gain, That's also cooled off HDFC Bank, and now it's barely holding on to the green. So it's quite a bit of slide that you've seen from the top of the day to where the stock is right now, barely holding on into the green. And it seems like more of a sentiment thing really, which is playing out on the entire, private banking pack. What is ICICI Bank and Kotak up to? Because remember, they also deliver their numbers tomorrow. We'll just have those stocks come up for you on your screens. But in the thick of earnings, so let me welcome on board Abhay Buttada, the MD at Poonawalla Fincorp, joining in the show right now. Abhay, hi, morning. Good to have you in the show. The one thing that struck the most was your highest ever quarterly disbursement figure, highest ever profit, lowest NPA and GNPAs. Before getting into details, what were the drivers for this kind of growth, especially at a time when some are saying that the environment is showing some slowdown in the lending space?
This is the efforts of the last 2.5 years. Post-acquisition, we have clearly articulated our strategy, the segment, our chosen segment of pre-owned car, loan against property, personal loan, business loan, supply chain finance, machinery loan, medical equipment loan, consumer finance. So I think the segment which we are targeting is a very different kind of segment. It's a combination of fintech, bank and NBFC. It requires a lot of courage to target this segment being an NBFC. But because we are a CRISIL AAA, considering our less cost of fund, low operating cost being a digital model, and less credit cost, we don't give loan to new to credit, only bureau tested customer. So technology, system, process, there are multiple things are there which are helping us to achieve this growth. The opportunity is huge. First, we have identified what is the total addressable market. And post that, I think we have started targeting slowly. You see, last 8 quarters, there is a consistent performance in terms of disbursement as well as the AUM growth. And most important here, I want to highlight, the base is very low. So it is easy to achieve this number. And we have given a guidance of 35 to 40. And considering the current base, I think in the future, we'll stick to our guidance of 35 to 40%. The focus will be on to achieve the asset quality, maintaining superior profitability, at the same time, maintain this 35 to 40% growth.
Okay, now Abhay, help us understand your outlook on future growth. And next few quarters, momentum is building up in all your spaces.
See, basically on a quarter-on-quarter basis, right now we are growing 8 to 9%. I think 7 to 8% quarter-on-quarter will continue to grow. And will, as I said, 6 to our guidance, that 35 to 40% will be our AUM guidance. See, in pre-owned car, business loan, lab, in terms of monthly disbursement, already we have taken major leadership. Pre-owned car, we have crossed 225 crore on a monthly basis. Loan against property, 350 crore on a monthly basis. Business loan, 250 crore. Out of 100 branches, even all 100 are not fully operational. So there is a huge opportunity available there. And over and above that, we have a consumer finance, personal loan, machine loan, medical equipment loan, so many diversification in terms of product range. So going further, you can expect 5 to 7%. We have incremental disbursement basis. We have taken market share at top 100 branches. Considering that, we are confident of achieving this growth.
All right, and let's also discuss your asset quality, because there is an assumption that the market is high growth and that leads to risk on your asset quality, but you have managed to maintain your asset quality. How has it improved and what is the outlook?
Yeah, very important here to note that it is very easy to go, but at the same time, easy to lend, but you need to collect the money also. So we are not into collection business. From day one, we are into risk business. So if you see the breakup of GNPA is 1.33, net NPA is 0.70. This is because of the legacy. Our new book GNPA is 0.42 and net NPA is 0.23. I think we don't expect credit cost guidance we have given between 0.8 to 1.2, and new book is performing well as compared with our expectation. Though somebody can say seasoning is not there, but if you see there is a bureau seasoning at a customer level, there is a business vintage, and we have done this in the past. So we are confident of maintaining net NPA below 1% as per our stated guidance of Management Vision 2025.
And given RBI's cautionary stance on unsecured loans, what is your own strategy going forward, especially when it comes to this segment?
See, if you see last quarter to this quarter, we have moved from 46 to 52% on the secured and 48% is unsecured. And we have taken major market share in pre-owned car, loan against property, secured products also. So considering that we don't see any major impact, our current leverage is 1.5, which is the lowest in the industry. Our cost of borrowing is also amongst the lowest in the industry. We are a CRISIL AAA rated NBFC. Our capital adequacy is 38%. Considering that even if we grow at 35 to 40%, we don't require any additional capital for next 3-4 years. So there is no impact of the new guideline changes on either growth or on the cost of borrowing side.
So are you maintaining your guidance of ROA, and what is the outlook here?
See, ROA, we have given a long-term guidance of 4 to 4.5%, but we are constantly reducing our OPEX, that is adding to the profitability. If you see on a year-over-year basis, in absolute term also, there is a reduction in the OPEX. Right now, including ESOP charge, it is at 4%, without ESOP charge 3.5. So next year, we'll be able to reduce to 3.5 OPEX to AUM. So that is adding to the profitability, and there is a less acquisition cost, less credit cost, and overall because of the less OPEX, it is clearly adding to our ROAs. So right now it is at 5.3. We are achieving much more than what we have guided. But on a long-term steady and state basis, we'll be able to maintain anything between 4 to 4.5%.
Right. And lastly, how is it that you're progressing towards your vision of 2025, your long-term goals in terms of financial metrics, profits, AUM growth?
See, so as per the AUM and as per the profitability, overall secured unsecured mix, profitability guidance, AUM guidance, I think we have given a guidance of short-term 20 to 25%, long-term 75 to 80%, and we are able to manage that. All the parameter of GNPA, NNPA, AUM growth, and the return on assets, I think we are able to over-deliver whatever we have given the guidance, and we are giving consistent performance over a period of, if you see, last 8 quarters, in each of the parameter, we are over-delivering on what we have guided, and we are confident of achieving the long-term metrics what we have stated, as well as management vision 2025. We have achieved most of the parameter. So now we will come out maybe 6 months down the line with new management vision 2030.
Appreciate it, Abhay. Thank you for joining us. Manoj Vishwanathan, Managing Director and CEO of Home First Finance, joins us. Now, Manoj, at the outset, sincere apologies, we've just put you on hold, but the way in which we got involved with conversations on what Ayodhya could be and where things are moving in terms of the religious tourism, we actually just extended our time there. So, Manoj, are you going to Ayodhya for the inauguration?
Not for the inauguration, but maybe shortly afterwards, definitely.
Are you getting business from that part? Everybody's talking about religious tourism, new epicenters of growth and low-cost housing getting created. Just an outside question, I'll get into your numbers, but is that a new business opportunity? Businesses around religious tourism?
So yeah, UP as a whole definitely is a big market for the future. We have recognized that. I think the market is also, people are also recognizing that. So we have made a couple of visits to UP. Earlier it was not in our radar for at least a couple more years. But now we have accelerated our movement into UP, our distribution into UP. So we have already put up a branch in Lucknow. We have a branch in Gorakhpur, and we are looking at a faster expansion in UP in the next 2 years.
I want to talk about your numbers as well, Manoj. Hi, morning firstly, because you've guided for an AUM growth over 30% for FY24. What kind of growth numbers have you already seen so far? And are you on track to achieve that guidance or perhaps even beat it?
The last 3 quarters, we have been delivering a year-on-year growth of more than 30%. I think last quarter was about 33-34%. So we are on track to deliver the 30% plus growth for FY24. As of now, we have our FY27 figure in mind, which is that we want to double from here where we are right now. So we have a target of 20,000 crores for FY27, and that is what we are, working towards.
The space which you represent, which is the HFC space, it's brutally competitive. Everybody wants to grow that book because it's a very secure book. Spreads are not the best. Banks like SBI have thrown their ring in the hat because they want to also make this book big. What will be a competitive edge?
Our competitive edge, from the beginning has been the way we use technology to make the process very seamless. I think historically this business has been always about has been product led. The company says, "Oh, this is the product that we have, and it's a one-time purchase for you, so take it or leave it." But we have gone to the customer with a different approach. It is about trying to find a solution for that customer. So a vast majority of customers have some or the other, you can say bottlenecks in getting the loan. They don't have all the salary slips. They don't have the right kind of documentation that ticks all the boxes with the larger entities. So our approach has been to customize the product and customize the approach with the customer and provide a very quick turnaround to the customer. In a housing situation, the customer is already dealing with multiple issues. Where to buy, which property to buy, when to how to give the down payment, which direction should the house be facing, and so on and so forth. There are multiple headaches the customer is facing while purchasing a house. So we try to make the loan process really fast and seamless for the customer. That has been our approach, and that has really worked for us. So today we are known for our quick turnarounds. We are known for our seamless approach in the market, and that's what is really bringing us business.
You're saying is exactly the right things, but the same structure architecture has been expressed by others also, that we are digital, we are known for a turnaround, we have technology, we have customer base, we have low NPAs. It's like similar sounding commentary I get from others also when I ask them the same question. Am I right? Am I wrong? Please tell me.
You are right to an extent, but I would still say that we were one of the early movers as far as this approach is concerned. There are a lot of entities that have come later or come more recently which are adopting the same approach. But there are some advantages of being an early mover. The market recognizes that yes, this is an entity that has been keeping their commitments for the last 13 years. When they say they are going to turn it around in 48 hours, they actually keep their word. So that is the brand image that we carry in the market, and that brings us a lot of business.
Is there a iota of slowdown because of rural, because of inflation, because what's happening in semi-urban market, and also affordability, Manoj? Let's be very clear. I mean, houses and land prices have gone up 50 to 100% depending on the pocket we are talking about, which is a serious impact on profitability because income in a sense is not growing at that level.
Yes, to some extent you're seeing that impact. So there is no impact on the growth as such, as you can see from our numbers. I mean, we have crossed our all-time high disbursal figure. We crossed 1,000 crores in last quarter. So there has not been an impact on the growth, but yes, there is some impact on the NIMs. There is some impact on the spreads, which we have been guiding for a while that yes, these spreads are likely to come down because we are likely to end up at about 5 to 5.25 kind of spreads, and that's where we are heading. So that's where the impact has come. But otherwise, on the overall demand on the growth side, we have not seen an impact.
So your capital adequacy, which is at 40%, which is strong, does that mean that ROE, which is a matrix investors look at, will only improve from here?
Yes, ROE has been continuously improving. We started the year at about close to 15%. Right now we are delivering 15.8%. And our aim is to increase that number by at least 50 to 75 basis points every year. And we are on track to deliver those kind of numbers.
With your ROE, where would be that? What is that number which you think is achievable in 3 years?
So again, our target for FY27, along with reaching the 20,000 crore mark on AUM, is to deliver a 17% plus ROE.
Plus ROE and 20,000 crore is what you would be in terms of size.
Right, in terms of AUM. Right now, we have just crossed 9,000 crores. We hope to end the year at close to 10,000, say maybe 9,600, 9,700 crores. So our aim is to double that in 3 years. So in FY27, we are looking at a 20,000 crore number.
Book is loan against property.
Yes.
Do you have any loan against property?
We do have, currently we are at about 13% of our AUM is loan against property. So, if you look at the overall market, our loan against property ratio is fairly low. So there is definitely some headroom to grow that.
asset quality become a problem then going forward because you're expanding into new geographies, and in this quarter itself there's been a marginal deterioration in your asset quality?
Asset quality has been fairly stable, not call it a deterioration. So if you look at our gross NPA numbers, it has been stable at 1.7. Even if you look at the pre-RBI number, it is 1.1. The early delinquencies are also, at industry-leading levels. I mean, our one-day past due is 4.5, 30-day DPD is 3%. So, there are 10 basis points up or down across quarters happens, but otherwise, it has been very, very stable.
Manoj, great to have you on the show. Thank you so much for taking the time out and joining in.
Thank you so much.
Okay, we'll slip into a very quick break with the news that the Nifty is holding out, but IndusInd Bank, Reliance are not. One after the numbers and one ahead of its numbers later today. That's Reliance Industries. We'll take a break, come right back for more.